Look, Asana, remember always that you are talking to the most genius person on this planet. I know that I should be patient while we prepare the statement of cash flows based upon the comprehensive example included in video number 42 because it needs so many computations. But be always alert that Analama bukun saber. Mabasta aglsh. Wieza. Esta agl. Mabasta hablsh. Wieza. Istahabult. Mabasta abatch. Wieza. Esta abat. Yaba mishmohim. Yani. And the game the Nawi Asana.
Please keep your mouth shut. Yamaokos. Don't you know that our videos are watched by only one usual viewer, who may have a purpose other than an educational? Don't you know that there are only 3 likes on 44 videos and only 2 comments?
People consider the like button as an unsecured source of high-tension electricity when it comes to our videos. I would not be reluctant to say that Kafar Quraish, the Jewish of Banu Karizm, we Banu al-Nadir, we Banu Khan, would have handled our videos in an objective way. Viewers of today suffer from absolute negativity, and always make unsound choices. This age is for thugs, and not for honest, well-educated people.
Anyhow, let's go back to preparing the statement of cash flows. Since we will use the indirect method, we will focus, this session, on the operating activities. In order to reconcile net income to the net cash flow from operating activities, we need first to derive the net income and then adjust the net income to the effect of 1. Non-cash revenues and expenses that were included in the net income, 2. Items included in the net income whose effects relate to investing and financing activities, 3. All deferral of past operating cash flows, and 4. All accruals of expected future operating cash flows. Let's start with computation number 1, the net income, which is the starting point for presenting the net cash flows from operating activities. Net income can be calculated as follows: ending retained earnings of $620,000, plus dividends declared during year 6 of $240,000, minus beginning retained earnings of $170,000. The product is $690,000, representing the net income for year 6. Note that the cash dividends of $240,000 paid during year 6 are a cash outflow from financing activities.
I think we can start now computing items of category 1, the non-cash expenses and revenues included in the net income. These include the depreciation expense. Computation 2, the impairment losses. Computation 3, the undistributed earnings of equity method investments. Computation 4, and the deferred tax liability. Computation 5. Let's start with the depreciation expense. Computation number 2.
Computation number 2 is the depreciation expense for year 6. This can be derived as follows: ending accumulated depreciation of $480,000, plus accumulated depreciation on items sold during year 6 of $260,000, being the difference between the historical cost of items sold of $400,000 and its carrying amount at the time of disposal of $140,000, minus beginning accumulated depreciation of $450,000. The product is $290,000, represents depreciation expense for year 6. Depreciation expense is a non-cash expense included in net income. Thus, $290,000 is added up to net income in determining the net cash flow from operating activities.
How we arrive at the impairment losses. Computation number 3.
Computation number 3 is impairment losses. Goodwill is not amortized. Thus, the $10,000 decrease in the amount of goodwill, being the difference between the beginning balance of $100,000 and the ending balance of $90,000, must be a result of impairment. A loss on impairment of goodwill is a non-cash loss included in the net income. Thus, it is added to net income in determining net cash flow from operating activities.
How we arrive at the undistributed earnings on equity method investments. Computation number 4.
Computation number 4 is the undistributed earnings on equity method investment. Under the equity method, investors' share of investees' earnings is debited to investment account and credited to income. A cash dividend from investee is a return of an investment that results in a debit to cash and a credit to the investment. The undistributed earnings on the equity method investments equal $15,000, being the difference between the share of earnings of $25,000 and dividends received of $10,000. This amount is a non-cash revenue included in the net income. Thus, it is subtracted from the net income in determining the net cash flow from operating activities.
How we arrive at the change in deferred tax liability. Computation number 5.
Computation number 5. Deferred tax liability decreased by $50,000, being the difference between the beginning balance of $300,000 and the ending balance of $250,000. The decrease of deferred tax liability increases net income by decreasing income tax expense. This decrease is a non-cash item included in the net income. Thus, it is subtracted from net income to determine net cash flow from operating activities.
Now we can start computing items of category 2, items included in the net income whose effects relate to investing and financing activities. These include the gain on disposal of the equipment, computation number 6, and the gain on sale of the investment, computation number 7.
Computation number 6, the gain on disposal of the equipment is $10,000, being the difference between the cash received of $150,000 and the carrying amount at the date of disposal of $140,000. Thus, the gain is subtracted from net income to determine the net cash flow from operating activities. Note that the $150,000 cash proceeds from sale of the equipment is a cash inflow from investing activities.
Now we can start in computation number 7, the gain on sale of investment.
Computation number 7, the gain on sale of investment is $35,000, being the difference between the cash received of $135,000 and the carrying amount of the investment at the time of sale of $100,000. Thus, it is subtracted from the net income to determine the net cash flow from operating activities. Note that the $135,000 cash proceeds from sale of investment is a cash inflow from investing activities. Also note that the carrying amount of investment sold of $100,000 is arrived at as follows: the beginning balance of investment of $300,000, plus equity in Yes minus current year earnings of $25,000, minus dividend received from Yes minus of $10,000, minus the ending carrying amount of $215,000.
Now we can start computing items of category 3, which is deferrals. This includes changes during the period in inventory. Computation number 8.
Computation number 8 is for inventory. Inventory is current operating asset. Inventory increased by $80,000, being the difference between the ending balance of $680,000 and the beginning balance of $600,000. The $80,000 is subtracted from net income to determine the net cash flow from operating activities.
Now we can start computing items of category 4, which is accruals. This includes accounts receivables, computation number 9, prepaid expenses, computation number 10, accounts payable, computation number 11, interest payable, computation number 12, and income tax payable, computation number 13.
Computation number 9, the accounts receivable. The easiest way to determine the reconciling adjustment of accounts receivable is to calculate the change in their net amount, which is accounts receivable at gross minus allowance for credit losses, previously called bad debts expense. Net accounts receivable are current operating asset. A decrease of net accounts receivable of $30,000 being the difference between the beginning balance of $510,000 and the ending balance of $480,000 is added to net income to determine net cash flow from operating activities.
How we arrive at the change in prepaid expenses. Computation number 10.
Computation number 10. Prepaid expense are current operating asset. Prepaid expenses decreased by $5,000 being the difference between beginning balance of $20,000 and the ending balance of $15,000. This amount is added to net income to determine the net cash flow from operating activities.
How we arrive at the change in accounts payable. Computation number 11.
Computation number 11. Accounts payable is a current operating liability. Accounts payable increased by $105,000, being the difference between the beginning balance of $720,000 and the ending balance of $825,000. This amount is added to net income to determine the net cash flow from operating activities.
How we arrive at the change in interest payable, computation number 12.
Computation number 12, interest payable is a current operating liability. It increased by $5,000, being the difference the beginning balance of $10,000 and ending balance of $15,000. This amount is added to net income in determining the net cash flow from operating activities.
How we arrive at the change in income tax payable, computation number 13.
Computation number 13, income tax payable is a current operating liability. It decreased by $10,000, being the difference between the beginning balance of $30,000 and the ending balance of $20,000. This amount is subtracted from net income to determine net cash flow from operating activities.
I am sure that we computed all the necessary reconciling items to net income to determine net cash flow provided by operating activities amounting to $935,000. Next session, we will arrive at the net cash provided by the operating activities in an itemized fashion. Thank you, Yusana.